Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it, generally related to three different topics: wealth building, commodities, and or financial topics. So let's dive right in, take a look, see what people are sharing, and I'll interject my opinions. If you want to follow me at @Finance, and if you want to join our community, finding-value.com, that's where I dive deeper into all of these subjects and topics, looking for potential investment opportunities. I share my opinions on how I read the technicals, how I read data, how I read the markets. Now, I am a long-term bull in commodities. Some people will say you're a perma bull. I am from 2020. That's when I started buying commodities, was the bottom of 2020. Yes, I didn't time it perfectly, but I timed it pretty dang good. And that's my view going forward from 2020, is that we are in a big, gigantic commodity bull market with waves going up. Wave 1, wave 2, wave 3, in terms of Elliott wave structures. If you're interested in learning from someone who has that kind of viewpoint and opinion, I am a long-term investor. I don't trade the short term necessarily, although I try to time my purchases on the short term. You can join up. We have a discount coupon code special is active on the website. You get a 50% off first month discount on the monthly membership, only the first month, and a larger discount on the yearly membership if you'd like to sign up to the yearly or switch from a monthly to a yearly. Use special as the coupon code. Tavi says, Trump's criticism of Powell brings back memories of late 2018. As a reminder, during the period, 2-year yields were eventually slashed by nearly half within a year. I see a similar pattern emerging today, however, starting from a much higher interest rate. To add, we are now facing a significantly tougher fiscal imbalance, which I believe will ultimately push policymakers to lower rates even further. Smoot-Hawley-style tariffs will also make it difficult to maintain yields at their current levels, in my view. I'm genuinely amazed that rates are still hovering around 4%, and I'd be very surprised if they aren't considerably lower a year from now. Just his 2 cents. So back in 2018, we did have the yield curve invert, all that stuff, and it was uninverting from 2018 and onward. This was the C19 crash. They usually occur after it's been pulling back for a while, and then you get some sort of event or crash in the market. I don't know if those are manufactured by government or Federal Reserve or someone. I'm not sure. 9/11 was also, the yield curve inverted and started coming back down, almost like the markets knew some sort of event was going to occur. So 9/11, C19, they have a lot of things that were in common, that a lot of big money was positioning in bonds before those crises occurred. Is something coming ahead of us where a crisis occurs and then they can roll over that gaggle of debt? I don't know. I can't predict markets like that. Maybe the insiders might know, but I am definitely not an insider. Right now, if I were to look at yields and chart it out, I don't know if they're going to drop. It doesn't look like they're going to drop like in free fall. Anything's possible, but from the charts, I still think they look somewhat strong, where they could even potentially go higher. So if I were to just, let me yank it up real quick and show you guys what I mean by that. And that's the 2-year yield. So we've got this big kind of move higher here with these big green candlesticks, and then a small pullback, which I think could still potentially head higher in the short term. And the only reason I'm saying that are these large green bullish engulfing candlesticks that we got, and then the small selling pressure down. That screams that yields might want to go higher here. But again, we'll see what happens. I don't know the future. Coming down, crude oil versus gold could be a bottom after the false breakdown. So this is cheap oil for the ratio. This is expensive oil. One would have done fantastic to sell oil when it's overvalued and to buy oil when it's undervalued. there are these windows of opportunity that we can load the boat in certain asset classes with these alignments. The alignments are the technicals aligning with how cheap something is. 2020 was ridiculously cheap, and that was the all-time best time to buy oil. It was 2020. We broke out of the falling wedge to the upside, and we've gotten a three-hump consolidation, this thing here. And that's squeezing into a falling wedge, and we have another false breakdown, much like 2020. There's the false breakdown, and now we've got a bullish engulfing that is formed on April 17th here. And that generally is a bottoming pattern to move higher, and we'll see if that occurs. Crude oil was putting some strength on the 17th, and gold was a little bit weak, creating this large bullish engulfing candlestick. We'll see if we get a move higher. Now, here's the thing. I can put this trade on, or I can put this investment on, and I'm still buying this cheaper than the entire bull market in 1999, 2000, which was here in the circle, and cheaper than any time in the 1980s from a oil to gold ratio. So if I'm wrong and I mistime something, I can just sit in it because I just bought a stupid, ridiculous, cheap asset. It also has, if you look and draw a line across here, let's do crude oil divided by gold. There's also an inverted shoulder head shoulder here. So if I were to draw a line across here, that there is a shoulder, a head, and then a shoulder, and we're at the right-hand side of the shoulder here. And then we're going to come back up, break out, probably do a retest of some sort or some sort of pattern, falling wedge, whatever it is. And if, guys, we get to the upper end of this up here, I mean, the oil equities are going to be ridiculous. I mean, ridiculous. The pricing is unfathomable for most people to comprehend at this time. Because what that means, and I'll just do some quick calculator. I'm bringing out the calculator, boys. So 0.15 divided by 0.02, that's a 7.5x against gold. Against gold. That means it outperforms gold by 7.5 times. Let's just say things get a little bit dicey out there. Let's say gold goes to 5 grand. We go 5,000 divided by a 1-to-8 ratio is what that was back there. That means it's $625 a barrel of oil. Yeah, crazy, I know. Will there be currency devaluation? Sure there is inside of that. Currency devaluation and a weaker dollar. Now, if that's the case and we're at, was it $70 a barrel or something like that, or 60? 63? I don't know, whatever it is. 63, let's do 63. That's a 9.9x from where we are today. And then some of these have like a 3 or 4x on top of it. So that's going to be like a 30-bagger plus for a lot of the companies that we are looking at in this general location here. And I'm not saying that's going to happen immediately. That's going to happen out in the future, whatever price it ends up being. I don't know what the price will be. But I highly doubt gold's going to go down. So I think oil is going to get repriced higher. I think we're going to have a problem in oil. And I think that problem is going to manifest itself between 0 and 3 years is when the markets will figure it out. They'll say, holy crap, we've got a problem in oil. When oil prices go up, probably well above the $100 mark, that is when we want to see if we can actually increase production of oil. If we can't increase production of oil and we run out of spare capacity, it's game on. And if we start to decline from geological constraints out in the future, then it's really game on because you're going to have to destroy demand like we've never seen before. It will cause recessions, it will have problems, and it could potentially cause problems with currencies. And I think that's exactly what gold is somewhat pricing in already, is that there's probably a currency problem coming. And I think this is going to be related to 2 things. It's 2 things that it's related to. I think we're going to have a problem with oil, and I think we're going to have a problem with debt. And the debt is going to create the problem with oil and expose it. And then the currencies are all going to fluff around because they're not backed by anything. They're just printing them out of nothing. So those things are the first to get dusted. And then your precious metals are going to go ballistic. And that's why you have a 45-year cup and handle pattern. on silver, because this is what's coming. That is my understanding of what I think the market is going to be. And this is going to be a run to safety when this occurs. And I think this is going to occur between 0 and 3 years out is when silver is going to rip. And I think it's going to be caused by money creation in the system, oil's inability to grow with that money or credit creation, and there's going to be a flight to safety in gold, which is already running. That's our leader, a flight to safety in silver. And there's going to be a huge flight away from the bond market. And it's already all in motion. Now it's just going to be realized this is the smart money already positioning for this. The dumb money will come and figure it out later. That's what comes later. Coming down, Baker Hughes gas rig count is up 1, and same with oil. We've got Egon von Greyer's investors in cash or securities will experience the biggest wealth destruction in history. It is essential to take the following precautions. So in his opinion, these are the precautions that someone should take. Don't hold stocks except for resource stocks, aka commodities. Remember that stocks held within the financial system are vulnerable to system failure. Don't touch any bonds with a barge pool, including government bonds. Governments can never pay the capital or interest with regular money, only with massively depreciated fiat currency, obviously created from nothing. Don't hold bigger amounts of dollars, euros, yen, or any currency in a bank. Cash deposits are at risk. In addition, the currencies will all fall rapidly. The Swiss franc might be slightly better, at least early on. Only hold personal property and not investment property. Get out of debt if you can. Get out of debt if you can. There's his opinions on what you should do to prepare for what he thinks is coming. And I think it's coming too, something similar. I don't know how bad this will be. I don't know how fast it will come. I'm not really sure. All I can say is that all of the charts that I look at, they have a confluence. It's the merging of all this information that agrees with what he is saying. The 40-year downtrend break in interest rates, the 10-year yield, that agrees with what he's saying. The potential breakout in silver, the breakout in gold, and then oil is going to follow behind it. It's going to follow gold, and it's going to rip. That's going to transfer all of this debt, fiat, garbage money in the system, all that they're creating. It's going to transfer it all into the consumer price index, and it's going to blow it up. It's going to blow it up. And really what it is, it's the destruction of the currency. It is the destruction and the value loss in purchasing power of the currencies. Imagine if the Fed cut rates 7 times heading into a trade war. I'm sorry, but this post is completely unhinged. What the heck are we doing? Seriously. And this is Trump. He's talking about the ECB is expected to cut interest rates for the 7th time, and yet too late Jerome Powell of the Fed, who is always too late and wrong, yesterday issued a report which was another and typical complete mess. Oil prices are down, groceries, even eggs are down, and the USA is getting rich on tariffs. Too late should have lowered interest rates like the ECB long ago. But he should certainly lower them now. Powell's termination cannot come fast enough. The heck is this? Now, I'm gonna say one thing. If he lowers rates, the dollar is going to eat it. It's going to eat it. So if the only thing holding the dollar up is higher interest rates. If he lowers interest rates, that dollar is gonna drop like a rock. The purchasing power of the dollar will decline rapidly. And I don't know what he's trying to do here. I don't know what he's trying to do. Now, some people are pro-Trump, some are anti-Trump. I don't even care. It doesn't matter to me. I don't care who's the president. But if you lower interest rates, you're going to see this is ridiculous. Oh, eggs that have come back for 2 weeks? They've held steady for a couple of weeks. That's not long enough. You lower rates, eggs are going to double, triple, quadruple in price. They're going to go rocketing higher. I don't believe a single thing in this quote here. I don't believe it. I am very, very skeptical. I don't think oil is going to stay down. I think oil is going to go way up. We're way undervalued. I'll show you that here later. I think everything's going to go up. And if he lowers interest rates in the face of that, I mean, the dollar is going to get smoked. I mean, smoked. Here's Liz Anders. The U.S. dollar hasn't had such a challenging start to a year in quite some time. What's he talking about? The dollar's already fallen quite a bit. I mean, how much faster do you want this dollar to fall? I mean, should we just go to the grocery store and pay like $50 for a dozen eggs? I mean, that's kind of where we're started here. And Trump wants even a weaker dollar than that? Are you kidding me? This is a disaster. All right, let's see what happens. Here's Logan. It says it's true that the housing bubble was already breaking before the 2008 recession. The peak total inventory occurred in 2007. The credit markets showed stress in 2005. 05 is when this started to break higher for total U.S. housing inventory. The crash occurred in 2008. The housing market and the home builders, they did a shoulder head shoulder. The peak of the head was in 2005, which was here. It was somewhere in this area here, and then it rolled over. Look where our housing inventory is today. Yeah, that's a huge bubble there. Huge, huge bubble with no inventory. I don't think you can be in a bubble, at least price-wise, if you don't have any inventory. You can be in a bubble, and people will refer to this. They'll say, people can't afford it because of the affordability. Okay, that does not make it necessarily a bubble. The 50th percentile may not be able to afford homes ever again. So why don't we compare it to the 75th percentile or maybe the 90th percentile? Well, what's the cost to replace these homes? What's the cost curve? Are we below the cost curve? Are we above the cost curve? If you notice, they're selling homes for ridiculous prices that are very small homes. I think the cost curve in the prices to build a home is going to go up vertically. And I'm not 100% sure that the affordability is ever going to come back for people. I'm not sure if the 50th percentile is going to ever be able to afford a home. You might have to buy it later in life, but I don't think 20-year-olds are going to be able to buy it anymore who are making a median income. Maybe the 90th percentile and above, but I'm not in that camp. I'm throwing out questions. I don't know for sure, but this is the reality here. And bubbles don't pop if we are in a bubble. Bubbles don't pop when you have no inventory. Now, when the inventory goes up, then I will change my mind. But the inventory is low, so I haven't changed my mind yet. OPEC Plus is bringing forward 3 months of production increase, but time spreads are showing strength, which is a good sign for oil. So time spreads are showing strength. And this also ties to a couple things below, which I'm going to get to. All Things Ventured says the fundamentals are the exact opposite of the narrative and the price. Snapback is going to be epic in terms of oil price. It says, whoa, check out the China data. Chinese days of crude inventory are the lowest in 7 years, despite record domestic production and record crude imports. The narrative of Chinese crude demand imploding is just totally false. Unless it actually implodes, crude imports will need to be sustained at an even higher level going forward, which means higher crude tanker rates. So he's playing this through the tanker rates. I like the oil producers. Investment Wisdom says, the higher the pessimism and related market fluctuations, better are the opportunities to enrich yourselves. So the next time someone asks you, does the stock correction affect you? Your answer can be, certainly, it improves my chances of getting richer, says Francis Rockin. Rock Bottom Entry says, this isn't a maxi account pushing relentless bullish narratives on your favorite commodity. We focus on commodity segments where the upside heavily outweighs the downside. It's simple as that. Fading the herd equals outperformance, and by nature, it's a lonely path. If you're buying bottoms, everybody hates it. That's how you buy bottoms. Oil, everybody hates oil. It looks fantastic. It's cheap as crap. It's starting to, I think, maybe perhaps turn around against gold. I think it looks fantastic. Now, that's different than everyone else. Everyone else, oh, it's down. It's really down there. It's like, yeah, no crap. That's what makes it cheap. That's what. That's how I made all that money in previous, in 2020 at the bottom there. Everybody said oil sucked. Everybody told me they were quoting Kathy Wood nonstop. Oh, this is going to go the way of whale oil. Oil's never going to get above $40 again. That's what Kathy Wood had said. And then people were constantly putting crap in the comment section about how oil was going to go down to 30 or 40 or minus whatever, and it's never going to go back above 40. I'm telling you, oil is going to go ridiculously higher, and it's going to be probably the limiting factor of what this world will be in the future. Like energy from oil is the cornerstone of our modern society. I think we're going to have a problem within 0 to 3 years. And that problem is not recognized right now. And we have a problem. The inventory of oil continues to fall. We are at 2000-ish levels right now, and our days to coverage is way lower than history. This is so ridiculous to have prices down here, given where we're at in all of this stuff. And maybe Besant and Trump are in there trying to do stuff. Maybe that's the problem. Maybe they're holding it down. I have no idea what they're doing. I know they released the Strategic Petroleum Reserve under Biden to get the prices to get down. And we needed a consolidation too, but we're about done with this consolidation. It looks close to ripping higher. Michael Gayed says, I will be proven right. At some point, gold will become a source of liquidity to support losing positions. Okay, I mean, sure. So I don't know. That just seems like a really ridiculous post. I think gold's going to go up over the long term. In the short term, yes, we could consolidate. Yes, we could go sideways. It's been ripping pretty hard. But like, what's the point of posting this? I will be proven right. I am Michael A. Gayed. At some point, gold will become a source. What's this prediction here, guys? Like, just let it go. He's not going to be proven. Yeah, I'll be proven right at some point, sometime in the future. All right, that's everything. That's like saying gold will go down at some point in the future. Good call, buddy. Great call. Kevin Bambrose says, yes, every bull market sees periods of retracement. This is to Michael Gayed. This call is only valuable if you correctly predict the times to load up and the times to take profits. Repeating that you'll be right, that there will be a retracement at some point is a none call. I love it, Kevin. I love it. Especially if the retracement ends up being only back to a point where you sold or started expressing the chance of a retracement. I think it's fair to say that most experienced gold investors acknowledge that gold could move up or down in the next 2 weeks by $500 or more. What matters is one's personal investment time horizon and plan. It's up more than 10x in the last 25 years. Will likely be up another 10x in the next 25 years. How have bonds performed versus gold for the last 25 years? How will owning bonds likely perform versus gold for the next 25 years? I say this because you often point out that you are intending to be annoying as heck. I wish you'd focus on being as helpful as possible instead, and that means getting people to focus on the big picture view rather than playing the week-to-week calls based on momentum and liquidity. I love it, Kevin. I love it. I mean, this is just retarded up here, guys. This is so dumb. And Kevin, I totally agree with his approach here. Look at the big picture view. Where else are you going to go? You going to go buy bonds? You going to go buy stocks? You going to go buy some overvalued cryptocurrency and tangible crap of nothing? You want to go buy that crap? What's the likelihood that the Nasdaq's going to fall and retrace quite a bit? It's a high likelihood. What's the likelihood that crypto is going to follow with it? Probably pretty likely. I'm not going to touch that crap. So where else am I going to put my money? Now, if you're trying to call these week-to-week movements based off momentum and liquidity, I mean, do you know how hard your life's going to be? Most of those people get it wrong. They use technical analysis, they apply it to the short term, and then they get it wrong. And then what happens? You lose your damn position in the biggest bull market in the history of mankind that we're at the beginning of. That is complete and utter stupidity. Complete and utter stupidity to the max. You know how you get rich? You don't get rich by playing these stupid calls by week to week based off momentum liquidity. I totally agree. You get it by buying undervalued assets and holding those assets for a long time. Everyone look at their portfolio. What has done best over time? And I guarantee when you look back, you'll say, oh crap, you know what my best performing investment has been? The one that I've held the longest. Almost always that's the case. Oh, I've held gold for whatever. Now I'm not talking about holding speculative garbage junior mining companies. Those are garbage, guys. They work under like the smallest of windows of opportunity. They don't work holding them over a 10 or 15 or 25-year period. What works best are these assets like gold, outperforming basically everything with the least amount of risk. So your risk reward adjusted adjusted against all these other asset classes is probably one of the best. Sorry, I had to get that out. So Doge's success is simply breathtaking as we spend more money in 2025 from 1st to April. Real time, we're spending more and more money than all the other years. Way to go, way to go, way to go. Plaquemines, which is the LNG terminal, ripping, while the Haynesville nat gas production is stagnant. This is setting up to be quite the supply-demand mismatch. Haynesville rigs haven't budged, currently at 31, and there looks to be an 8-month lag between rig activity and production movement. Regional TILs have been chewed up, and the drilled uncompleted wells sitting at operational inventory levels. So no backups left, and we likely see no production growth from the Haynesville, which is local to the Henry Hub area, region for the rest of 2025. Why does this matter? See this tweet. And we've got all of this LNG capacity coming online, and the prices are too low to jack up the production of natural gas in the Haynesville. It's going to get squeezed here, guys. It's going to get squeezed. And yes, we are playing this with two of my picks in natural gas is going to benefit dramatically from this. And the drilling companies will too when drilling starts to come back. It has to come back if we're going to fill all of this, all of these LNG terminals coming. Here's JSG. Total commercial petroleum stocks, excluding other oils, is down 6.7 million barrels week over week. It's the lowest this metric has been since October of 2022. The calculated WTI fair value price is $95 a barrel. We are outside of fair value over 2 standard deviations. Am I going to make bets down here? Oh God, yes I am. I'm going to make bets down here like you've never seen before. Well, I'm already in it. I've been buying like a freaking madman. Whatever I can. It's undervalued. It's undervalued versus gold. This is the alignment I look for. And a lot of the companies are way down. You're paying price to book under 0.5, baby. This is the exact same scenario as 2020. Did you know in 2020 when I was buying, the gold to oil ratio was at just over 50. It was like 52. And you know where it is today? 52. And you know what it is with this too? This is far undervalued at $95 fair value price if you were to look at the dot plot for commercial inventory levels. Go look at inventory levels onshore, on water. Go look at China's inventory and Europe's inventory. It's all low. We just talked about China's inventory up here being at a very low level, wherever it was. Everything is low right here. This is such a great opportunity. It says, whoa, check out the China data. Chinese days of crude inventory lowest in 7 years, despite record domestic production and record. It's the lowest in 7 years. All of our inventories are depleted. How are they holding this price down? We're going to see a snapback here at some point in oil. Freight futures, AM update. We've got dry bulk. Capesize and Panamax are up 1%. Tankers, VLCC is up 3%, and Suezmax is flat. Warren Pye's talking about housing. Single-family starts fell to 78,000 for the month of March, which is pretty low. This is the second lowest monthly print in almost 2 years. This level of starts does not support the current construction labor force. 7% mortgage rates do not fit the housing market, which is restrictive. So affordability is impacting our housing starts. Our housing starts are going to impact the unemployment, because if we stay lower, it goes lower. We could see unemployment shoot up from residential construction. That would signal a potential recession. Now, here's the thing that Powell is stuck in. He's screwed. You've got recession potential setup in unemployment. On the other hand, if he lowers rates, he destroys the dollar. So he is stuck between unemployment and inflation, which is going to be a stagflationary problem. And I don't know what the heck, I don't know what he's going to do. He's going to have to favor, do we keep the dollar strong and try to keep inflation in check? Or do we lower interest rates, re-kick the housing market going, save the residential construction, because that's the majority of where this is going to be impacted, the employment in residential construction. And then do we just kill the dollar and let inflation run? I don't know what he's going to pick. I think he's screwed. I think he's screwed here. China's domestic oil production surged to an all-time high of 4.5 million barrels per day in March, according to official statistics. The data feels a bit too hot, but if confirmed, the message is clear. Drill, baby, drill is happening in China. Here's another thing, though. They're at 7-year low inventories. 7-year low inventory. That stimulus coming that they're printing, it's going to create demand for oil. Here it comes. CNBC continues to avoid speaking on gold because they understand if gold went parabolic, it would signal either a significant market correction, stagflation, a dollar crisis, plus other not so good things. I think we're in a dollar crisis. I think we're in stagflation. And I think we will have a significant market correction. I think it's all of the above. Chinese gold trading activity explodes. What are they trying to tell us? Probably that they're buying gold. That's what it means. I don't know the reasons behind it, but they're buying it, that's for sure. Eric Nuttall says there's an insatiable demand for Canadian energy, and meeting that demand is the surest way to improve our quality of life while also defending our sovereignty. Anyone who says that the new pipelines would not necessarily get future government approval just doesn't get it. And this is China pivoting from the U.S. to Canada for more oil as trade war worsens. I think, Canadian energy is like the last best spot in the world. And I think there's going to be a fight for that exportable capacity. I also think that Canada needs to increase its defense because I think that oil is going to be highly valuable in the future. Highly, highly valuable. Peter Schiff says, what does the Fed do when inflation, unemployment, and the 10-year Treasury yield are all 6% or higher? I don't know what they do. That's the problem. They lower interest rates, inflation goes up. They keep interest rates really high, unemployment goes up. And then the 10-year yield is going to rocket higher. Either way, I don't know what the heck they do. I don't know. I really don't know what they're going to do. They're in a very difficult position. Unusual whales, just in, Chinese refiners are importing record amounts of Canadian crude oil after slashing purchases of U.S. oil by roughly 90% amid escalating trade war, per Bloomberg. Canadian oil, man, that's going to be the spot. Everybody's going to want it. And that's where I'm going to end it, guys. So that's what I've got for today. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. And that's all I've got. We've got a question and answer session coming up on Sunday at 5 p.m. Mountain Time. I think markets are closed on Friday, so yeah, not a great day. I like when the markets are open; I can watch it. But I think there's Good Friday, so hopefully everybody has a Good Friday. So I'll see you next time, guys. See ya.